Hi, this is Jeffrey Cohen. It's a redo, week 4, 2021. We're going to talk about the markets. We're going to talk about business. We're going to talk about how we're doing with our quantum computing. Lots of things to talk about. And all right, let's get started. We're going to try to make this fast too, because it's Sunday. And second time we recorded, we're going to replace the first recording with this one. So the first key takeaway is we can now run with a risk factor in our analysis. So I didn't know actually how big of a deal it was, but when we adjust our exponent on the expected return calculation, we can actually pick different stocks, and they still have the zig and zag. They still have the Chicago Quantum kind of secret sauce, but different stocks, more stocks. So when we lower the risk, picks more stocks with a lower expected return, but also a lower volatility. And it's nice for those, we like to say, for the widows and orphans out there, widowers, widows, and orphans who want to save their money. They might want to run with a lower risk analysis. So today we have not added this to our service, but you can make a request during checkout. Now that you know, you could say, hey Jeff, hey guys, I sure would like a lower risk, and we can talk to you about that. So that's good. Medium is the way we always ran, so we're always medium. It's just that we can go high and low, and consistently have different stock picks, and we better understand more variance, more volatility. So second thing I want to talk about is the long bond rates. They're moving. First off, what's a long bond? What is a long bond? It's a good question. Let's see if I have it in our Chicago Quantum frequently asked questions. And pretty sure I do. Here we go. What's a long bond? By the way, it's not a 2-hour James Bond movie. That would be a long bond, and I love James Bond, but that's not it. It's a bond with a maturity of 5 years or more. So what happens, we usually look at the U.S. Treasuries. They're considered risk-free, and so it really values the maturity as opposed to the risk. So if you were to pick a stock, a company, and take their bonds, now you have to figure out their specific risk factor. So, and in many cases, right, there's a 30-year bond that was opened. Could even be 7, 8 years ago, but they reopened them to issue more debt. As they're 8 years ago, 22 years left, it's a 22-year bond. But still a 30-year bond, but it's how much time is left. And so we look at anything with over a 5-year. And so I pulled the data, and what you can see is this week, starting on Tuesday, the yield on a long bond went down, went up. So you'd say, all right, Jeff, what's the big deal? Let's take a look over a month. It's up pretty good. Over a year, the yield plummeted during the recovery of COVID and has been working its way back up. So what that means is money is going to be more tight. Money is going to be more expensive. There's an alternative to putting your money in the stock market. People might go a little risk off, sell off some of the exchanges, the equity exchanges, and move into bonds. I mean, let's be honest. I was thinking about this. You know, when I was a lot younger, there was a 13-year, 30-year treasury. Not 13-year, a 13% 30-year treasury. Can you imagine if I bought a 13-year nominal interest bond, or God help us, a 13-year TIPS, you know, a treasury inflation protected bond. It guarantees you 13% after inflation, real interest. Oh, this is crazy talk, right? Why would I ever be in the stock market? I'm getting 13 points. I probably even get some tax benefits. We're done. Now, at 1.09, I'm not done. But it just gives you a sense. Please watch the 10-year, watch the 30-year, watch the 5-year. As these things start to rise, it puts a bit of a damper on the stock market. So that's the first thing I wanted to talk to you about. The gamma squeeze on short sold stocks continues. This pulls attention away from other stocks It creates a bit of uncertainty in the market, and it got me to spend some money. By the way, NASDAQ Book Viewer. So this is the coolest thing ever. By the way, I'm going to show you. So it's 15 bucks a month. Not a big deal if you're really trading stocks. If you're just watching, there's other free services that are really great. So what happens is you put in your stock. Let's say do GME, GameStop. I mean, market's closed. Right? AMC, market's closed. So what happens though is during the day you're going to run this and you're going to see buys and sells popping all day. It's like a movie. It just it pops. And what you have is you have the time of the order was entered. You have the identity of the person making the order or the trading house, settlement house. You have the number of orders, so it could be at $1. There's 5 people wanting to buy or 5 people wanting to sell. There's the market value of the order, there's the bid, there's the total, which is accumulative, and then there's the shares. I've actually got a couple screen prints of this. I love the NASDAQ Book Viewer. If you get a chance and you're in the market, I mean, there's other ways you can do it, right? You can go to the CBOE, type in CBOE, Exchange Book Viewer. We're going to use SMLP as our example. And so here you go. You get the 5 bids, the top 5 asks. It's going to go from the center out. So your best bid's at the top, your best ask is at the bottom. Here's what traded last 10 trades, 4 exchanges. 1, 2, 3, 4. EDGX is where a lot of our trades have been made. It traded 11,330 on Friday. 2,437 orders were accepted. It doesn't mean they were executed. It just means they were accepted and they were posted. They could have been order, cancel, order, cancel, order, cancel. A lot of what we do when we trade. But you can see the last trade of the not of the day at 4:34 p.m. Actually, 3:34 p.m. The last trade on this exchange was for $15.42 for 1 share. Always interesting. We talked last week about pumpers and dumpers. The other thing that's important is to know that there's still a lot of play out there. So I do costs because I know that's one of these pump and dump. We can use GME. We can use Nokia. So Pineapple Stocks, Paco, Diogenes, Marcus Sparza. I might actually know that guy. Double Top, Trouble Ahead. There's all these companies, right? And so are all these people, and you can follow. You can follow a lot of excitement, in the markets, and so this is very distracting, right? Because what happens is I'm spending my time when I should be looking for maybe new trades. I'm spending my time on these. Let me zoom on in for you. So you want to know where the gamma squeeze is? It's where Robinhood has restrictions on trading. Get over here. Come on now. I'm so sorry. Let's move it over. Right here. AMC. BlackBerry. Express stores outside the United States and some mail order. GameStop. I don't know who GNUs are. Koss is a headphones company. Naked is it's an e-retailer out of Australia, and Nokia. And so I love it. I love watching. Look what's happening now, right? Look at this. 15 minutes early. Dope. Wing looking for 80. I mean, there's a lot of stuff going on here in terms of the market, in terms of people still looking for stocks that are going to go up, right? Tesla shorts. There's just a lot going on, right? And so you can watch these, right? I'm probably going to add these into my. It's from Astral Trades. Give them a little credit here. All right, so they are. There's things going on out there, and so I find it very distracting myself. It's okay. It's okay. Just know. And the gamma squeeze, the way it works, is, again, let's see if it's in my FAQs. I'm pretty sure it is, otherwise I wouldn't be taking you there. What's a gamma squeeze? It's important you know this because it's happening. By the way, I bought my first options this week on the one stock that we're long on, and it was pretty cool. So, gamma squeeze is a closed loop or a virtuous circle where the buyers, say a whale, big buyer, billionaire, investor, or many small fish. Think of the Wall Street bets or the Twitter guys. They buy short dated call options. So what happens is the call option sellers, they're not emotional, they're not invested. They're just trying to make a commission here. If they can make $1,000 selling a call option, why not? But then they're going to hedge, right? So they're going to buy the underlying 1-for-1 or maybe a 0.7 to 1 or 1.2 to 1, right? Like clockwork. There's not even a choice. I sell you a call. I'm not going naked. I'm covering, right? So if this happens enough, the stock price goes up really fast because I buy a call, you buy it. So by the way, I've also bought some of the stock myself, right? So I buy the stock I'm holding. Now I buy the call. You seller are going to buy the stock. You seller are going to buy the stock. You seller are going to buy. For next thing you know, and these are short-term options. They might only cost a nickel, a dime, a quarter, right? But nickel, dime, and a quarter, now you got to buy a share. I do 10, 50,000 contracts. I do 10 contracts times 100 is 1,000 shares. I could really move the stock, right? Now, what happens when the call options expire? Well, that's a really good question, right? I think what happens is they can then sell the stock. But if you keep buying calls and you keep rolling over the calls a week, 2 weeks, 3 weeks, they got to hedge. And so the other thing that happens is the call options do become more expensive to count for the hedging risk. A gamma squeeze can also happen with puts, right? Bunch of people buy puts. The seller's got to hedge by selling or shorting the underlying stock. Stock drops, buyers feel more confident, they buy more puts, right? Same thing on the calls. Imagine you bought a call, stock price goes up. You feel like you're so smart, so you buy more calls. Stock goes up again. By the way, it's a virtuous circle. That's my point. Okay, that's a gamma squeeze. You got to be thinking about it. It's real. It's real. So, by the way, I hope I'm presenting to you guys. I just realized I cannot see my screen where I'm supposed to be. There I am. I'm live streaming. Thank you. Thank you. All right. 12 and a half minutes in. No questions. That's great. Let's keep going. Back to the list. I had to make a list because I start to forget, right? Friday saw declines over most of the global equities markets and most of the U.S. equity industries. So I figured out how to figure that out. So I did this during the day. It was kind of interesting. So we're just going to go for the one-day performance world. So over the past day, I'm looking at China, mostly red. Japan, a lot of red. Taiwan's red. India, a little mixed, right? Southeast Asia, Singapore, Australia is pretty red. Look at that. Brazil is bleeding. It's like red beans and rice down there. Bermuda's red. Caymans are red. Mexico's red. Canada. I mean, you got a couple of greens in there, like some precious metals, maybe. Biologics, but in general, red. Red, red, red. So, even Ireland's red. Come on, I love Ireland. UK, love the Brits. Red. Swiss, Dutch, Germans, Belgians, French. Everyone's red. So, how's the U.S. doing? Oh, this is one-day performance S&P 500. Let's look at the full. Jeffrey, don't just show us the S&P. Show us all the stocks. Give us all the goods here. All right. It's pretty much all red. There's a couple of diagnostic companies in there. By the way, Danaher, used to know someone that worked for them. Great company, great management team. So what? I got 10 stocks up in the whole market. Look at the energy. Blood red with one exception, SSL. So Tesla's down 5% for the day. Amazon's down a point. Everyone's Apple's almost down 4% on the day. The banks are down. The credit cards are down. Insurance is bad. Forget about it. Friday was a bad day. Let's hope y'all get a good night, good rest on the weekend. You come back on Monday. Let's hope this doesn't continue. We are definitely going to be looking at those futures over the weekend. Um, but this is very important. Okay, so the market isn't just made in a day. Let's take a look at the week. I ran the week. The week's pretty red too. You'd think it was red, bad. Tesla's down 6.5, 6.25. Amazon's down almost 3. Facebook down 6. Apple's down 5. Again, credit services are down. Banks are down. Capital's down. Drugs are down. Come on, with COVID, everyone's down. Look, restaurants are down. Retail, energy is. There's not a green name in the house for energy. First off, I'm going to have to talk a little bit about the pipeline thing, but maybe I'll save that to the end. So there's a little political thing coming at the very end of this talk about pipelines. I think there's a national security implication, so I'm going to put my 2 cents in there. Aerospace and defense is down. Look at that. Boeing's down almost 6 points for the week. Lockheed Martin's down 5. Northrop Grumman. General Dynamics. We're just down. Raytheon. So, not a good... but come on, Jeff. How about for the year? Give me a good story. I'll give you a good story. For the year, Amazon's up 71%. Tesla's up 500%. Okay, you need a good story? Amazon's up 71, Tesla's up 500. It's a good story. Even General Motors is up. Look at that, 52% for the year. Apple, 63%. So you know what? You need to feel good. Pull out a year. Now, let's be honest. Pull out a year. Energy is still dying here. One green name, Cabot. Everyone else is red or 0, right? Utilities are down. So it's interesting because you know the Chicago Quantum Net Score looks at a year's worth of data. So when we're crunching stocks, we're looking at a year's worth of data, right? We're looking at this chart, but we're also looking at this chart for the day. It matters, right? So I just want to talk about how for the year we've made money, for the week we've lost money, for the day we lost money. So what happened this past month? Was there any big news? I don't know. Maybe something happened or something. So I don't know. Tough business right now. If you're in the equities business, it's a tough market. So let's take a look at Bitcoin. How's Bitcoin doing? Let's pop it up here. Bitcoin looks great for the year. Look at that. About 10,000 for about 9 months. And then, boo! It's back up to 32.9 right now. Right? Looks like it's hitting a consolidation pattern in the 30s. $30,000 for a Bitcoin. So that's interesting. So we talked about the long bonds. Let's talk about oil, right? I think oil is a good determinant for our overall economy. And so let's take a look at for a year. So the way oil's been going, we had that period where it went to 0, but come on, or negative. That's weird. That's just we ran out of storage space. But in general, you've been looking at $40 oil since June. June, July, August, September, October, November. You're still looking at $40 oil. Finally, we're at $50 oil. So December, so November into December, into January, you got 2 months, right? So if I'm looking at oil companies who are not hedged, I'm looking at an increase in 25% in the underlying commodity. I'm feeling pretty good right now. So I'm expecting to see earnings up. This is just my own personal opinion. Do not bank on this, but oil's up. As long as oil stays up, we're in pretty good shape here in terms of oil and gas. What else is important to talk about? You know, we have 3 exchanges that we follow. GSPC is the S&P 500. IXIC is the NASDAQ 100. And RUT is the Russell 2000. So a lot of people, I got to be honest, I'm just as guilty, right? I used to think if I want to diversify, why would I ever want a Chicago Quantum Net Score? That's way too complicated. I'm just going to buy large cap, medium cap, small cap, or I'm going to buy large cap, small cap, and tech. Because, Jeff, I get all the diversification I need going with passive index funds. And I can buy them through Vanguard, BlackRock. I can buy them through Fidelity, any of the mutual fund companies, a couple of basis points. I don't need to spend $75 on your model, Jeff, or $50 or $1,000. You're crazy, man. I'm just going to hedge away my risk with big stock, small stock, tech stock. Unfortunately, we got a problem. So we look at this week, right? And by the way, I just posted on Medium. I'll probably end up showing it to you. A bunch of our stock picks. But what happens is when you take a look at the market like this, it started, so this is 1 week. I just looked at 1 week because I'm doing a weekly review, week 4 of the stock market. Okay? Where'd we end up? One exchange is down 3.1%, one's down 2.5%, one's down 3.0%. That's no diversification. You're within 0.6% for the whole week. Now, there were moments, I will admit, there were moments when it looked like you were going to get some diversification. Right? Like here, on the 25th at around 10:35 a.m., you were diversified. You were loving life, right? Because the Russell went up. That was the whole GameStop thing. That was when we were like driving the price of GameStop up, and I got to tell you, it probably drove the Russell up. But even with GameStop, by the end of that, by 11 a.m., look at that. Half hour later, they were all at the same price. All the exchanges, all 3 of these indexes. Same thing happened there on the 27th at 10 a.m. I mean, these are all, there's no diversification, guys. I don't know what you're thinking. And I got to be honest with you, I've wasted a lot of time in my life perfectly balancing between index funds. I don't see it. I mean, this is probably worth an article in and of itself. I'm going to make a copy of this page right here. But you guys should think about this. You think you're diversified because you got a couple different mutual funds, but really, you got to find stocks that zig and others that zag. So I wanted to talk about that. I'm glad I got to that. What else? Oh yeah, we updated our picks in Medium. We dominate the S&P 500. I got to tell you, I'm really sorry because I'm going to sound a little cocky, but this thing makes money. It's killing me. This thing should be like coming off the hook. I should be so busy on a weekend running 20, 30 jobs, but we're not. Let's just take a look. What did we pick on January 11? It was like, dividend payers only. We added something to our model. We can now pick out the companies that paid a dividend. So I got to get to the gist here, right? We ran it on the 11th. Hello, Chicago Quantum followers. Picked it on the 11th. What did we pick? Here we go. Got a nice picture. Let's take a look. So, 13 trading days. Time will tell. By the way, these stocks were also hit pretty badly in the market. The market decline. Doesn't matter. If you would have bought the best Chicago Quantum net score, which would give you when you buy a service, you'd have been up 2% in 13 trading days. And that's not bad. How many trading days in a year? 250. That's about 5% of the year. You'd be up 2 points. By the way, the baseline, S&P 500, was down 2 points. So you have 4 points versus baseline. We had the fourth stock, which we would have told you. It's up to you. But a lot of times the model picks a choice that's just tiny bit worse. But you add a fourth stock or a fifth stock. And so you feel good about that. You're diversifying, right? Well, that one, if you would have taken that bet and added stock, it was Clorox, by the way. The guys that make the bleach, Clorox. You'd have been up almost 4% in 13 days versus down 2 points. 6-point outperformance. Now, we ran it. You could say I was being self-serving, but honestly, I just wanted to get it out there for you, right? So picked a few stocks. Take a look at our Medium posts. I probably should add this to the to the write-up. What I'll do is I'll put the write-up in the video. So now let's go back, see what else we picked. By the way, my team does not like that I'm keep giving away these runs, because honestly, I'm giving away the store here. Jeff, what are you doing? Who does that? Who gives away work for free? Well, I do. You know why? Because I want you to understand how it works. You're not going to go invest your hard-earned money on something we ran 3 weeks ago, but you'll understand the visceral nature of this picker and how it works, the energy flows. I mean, I can start talking like Luna Lovegood, Harry Potter, but I'm not going to do that, right? I'm just going to tell you we use a lot of physics, we pick a lot of stocks, we tell you what we picked. So what's interesting is this one, we ran 3,500 stocks. We exited validation with 3,200. We're pretty aggressive with our validation on data, okay? These are the best picks. So we ended up doing 3 risk categories. Remember I told you? Got a new risk thing here. We can run with a risk factor. So let's figure out, what do we do here? Medium risk is what we always run. Always run A-Mark, Sundance Energy. For those who followed our show, you know that I talk about Sundance Energy. I tweet about Sundance Energy. You need to be very careful if you're going to invest in Sundance Energy, because they are in default, cross default on their debt. They have a forbearance agreement that expires on February 7. What that means is on February 8, the debtors can either just be cool, negotiate, whatever, or they can demand immediate repayment. And they're bankrupt in 2 seconds. The stock goes to like 10 cents, right? A-Mark, I love A-Mark. They make stuff out of gold and silver. They do precision gold work and silver work. I love the stock, right? And then PDC Energy, you guys have heard me talk about that. That's an energy producer largely out of Colorado. Low debt yield. They're not that leveraged. So when the underlying goes up 25% oil, they make more money, okay? So this portfolio was up, medium risk portfolio, around 24.5% versus the Spider, S&P 500, that was down 3.7%. So that's a 28-point outperformance in how many days, Jeff? How many days? So it's January 21st at the end of the day. So it starts on January 22nd. 6 trading days. I can't promise you this every time. I'm sorry. If you spend your hard-earned money on me, and if you would have spent your hard-earned money on me 6 days ago, 7 days ago, you'd have made 47% for the highest risk choice. Medium risk, you'd have made 24.5 points. This is interesting, though. You could have said, Jeff, I'm a senior citizen. Don't do that to me. Give me a low-risk pick. The low risk, similar to the other one we did with the dividends, is up 2.2% versus a loss of 3.7% for the baseline. So you're still making money. You're not losing any sleep at night. Okay, who'd we pick for the low risk? Talk to me. I got A-Mark. By the way, A-Mark showed up in both high risk and low risk, which is interesting. I don't know what that means. It's interesting. Cargill. I think that's General Mills. Hormel. They make good chili. I love the chili. 3M. Sticky pads. Tape. The basic stuff. And Watt, I forgot who Watt is. It might be Watson. Watson Wine, I'm not sure. No, whatever. At least you get your food groups in, right? You did make 2.2%. And what's interesting is this portfolio was like a racehorse. I mean, it jumped out of the gate. Jumped out of the gate. By the 27th, we were doing great. But I got to tell you, the market falls. The Chicago Quantum Net Score falls. And so you see how we ended. We ended with 4 stocks in the money. 2 stocks out of the money. I mean, one was about 0. Versus an index that's had a really bad week. And so I just got to tell you, I'm there for you. I love you people that are listening. I love our customers and our clients who are buying the models. I want you to make money. I want you to understand the risks. You decide whether you're going to invest. You might just do this for academic purposes. You might just love quantum computing and say, you know what, Jeff? I love that you do this with a quantum computer. Let's spend an hour afterwards. Here's a couple $100. Just show me how you do it on a quantum computer. Run some stuff on the D-Wave and show me. Run something on the IBM and show me. I'd be glad to do that. I got to tell you, this is easy. But the truth is, we found a model that works. I am very excited about this. I'm very excited about this. What else do we have to talk about? And we're putting them in medium 6 days ago. You could have made 40%. I don't understand. I honestly don't understand. How do you do that? There may be some hocus pocus here. I'm sorry. There may be something going on I don't even understand. All right. In the spirit of full disclosure, I, Jeffrey Cohen, and my colleagues, we have one stock that we're long in, SMLP. So this was picked earlier. It was picked in January, and it's picked back as far as November 2020. We took a position in this stock this week. So it's not like I had this the whole time I was making predictions. No. We picked it this week, and we've done significant fundamental research on the company in order to do that. Now, of course, a lot of risk in the stock. Oil and gas, pipeline. They run pipelines. They do services. They put the water. They sell the water. They sell the compressed gas that you can put in for the fracking. They're in, I want to say, 4 completely different basins, non-conventional basins, where there's shale and there's fracking. And they're at risk if more pipelines, domestic pipelines only in the U.S. are going to be canceled, because they've got the Double E pipeline. They've spent 125 million out of the 300 million already of their share. ExxonMobil has the rest of the share. They do 70%. ExxonMobil does 30%. By the way, ExxonMobil, XTO Energy, one of their subsidiaries, they're one of the anchor tenants of that new pipeline. Just want to show you, and I want to show you what a stock looks like that we might invest in. So, if you look at Summit Midstream Partners, and you look at it through the really into the bad times of November, right? So, it was down. And it ran. It ran in June. Boy, it ran. And then it came down. It actually started trading under $1. In November, they did a 15-to-1 reverse stock split. So if you had 15 shares, you ended up with 1 share. So when you see a stock price of $15, you see a stock price of $1. 15 to 1. So we're at 15.55 right here. You're at $1.03. Okay, so the stock's got a lot of room to run. It's been consolidating. It ran here. I think that's because the pumpers and dumpers got it, right? I was amazed because we picked it, and 2 days later, the pumper and dumpers got it. And they took the thing up 70% over one night. That was great. We made money on that trade. We made a lot of money on that trade. Enough to pay my entire monthly set of expenses. So we're back in. We're back in at 15.33 is our average price. We also bought some options. So we're waiting for this thing to run. We're very excited about SMLP. And but we've been tweeting on it. And I want to show you what that looks like. Because I don't know if you guys are on Twitter, but I love Twitter, right? Chicago Quantum. We have our own Twitter page. So, 2 articles presented from our website. Disclosure, we are long SMLP. Okay, so we're letting people know I am long SMLP, right? So it's full disclosure. But I picked it a few months back. I like the intrinsic value of the company, quality and expertise of the management team, and good assets. Great margins. These guys got great margins. And they're building out the Double E pipeline, which should come online by Q4. What's funny is I went back in time. So it's a $300 million capital cost for the build out of the pipeline. They've got the $175 million that they need through TPG alternate assets. They've already spent 125 million, and this all started before ExxonMobil even took the 30% stake with an SEC filing. We found the SEC filing. It's the contract with XTO Energy. I love that. I love how everything's out there. This guy's going to make a boatload of money. So let's see if we can find what the margin is. I don't know from a lot of these statistics and metrics. I don't know that I even care. But gross margin, 69%. Who makes 69%? Operating margin, 39.5%. Love that. Profit margin's down because they did some write-offs. It's okay, though. They were doing some financial engineering. They were cleaning up the balance sheet. They're getting rid of about $500 million worth of debt. They're doing some very, very smart things. Shares outstanding is about 3.5 million shares. The float is tiny. There is a short ratio out there. There are some shorts out there. And so this could be a short squeeze. Who knows? Beta's pretty high at a 3.5. ATR, average true range of $1. So what's happening is if you look high to low every day, you got about $1. That's a lot of volatility. It's important that you look at that. Let me get back to my list. Multiverse. By the way, looks like a good firm. Roman Oris, a couple of guys that I haven't met yet. They're a European financial service consultancy in the quantum space. They did a great presentation with D-Wave Systems. They use Gecko, which is a Python library, as one of their solvers. You telling me that there's a new optimizer out there that we can add to Particle Swarm and simulate a bifurcator? We can add it to our simulated annealer, our genetic algorithm, our quantum annealer, our Markov chain Monte Carlo, and our fat-tailed Monte Carlo. I'm all in. I'm all in. We're going to try out this Gecko thing, and we're going to see if it works. And if it does, we're going to add it to our stable of solvers. So I want to thank Multiverse for finding Gecko. So I made a whole joke about Gecko. By the way, it's just a simple pip install. I'm pretty excited about that. I'm going to definitely try it out. Let's see. So, lastly, Microsoft Azure Quantum. Now, we have not talked about Microsoft Azure Quantum. We've talked about IBM Quantum. We have. We talked about a few things. We never talked really about Azure. So, one of our colleague companies, I call it a colleague company because they work with governments, U.S. government, U.S. federal government contracts, and they have a bunch of credits for Microsoft Azure. And so they're willing to partner with us, right? They don't have a quantum arm. We're the quantum arm. Now, we're just friends, but we work together, right? And so they're willing to provide us use of the credits if we can come up with a service that maybe the feds, could benefit from. Now, maybe the feds want to make money in the stock market. I don't know, but maybe they just want to analyze the stock market and look for above threshold risk factors. We can help them do that. So right now we're going through Microsoft Azure Quantum training. It's early days, and the quantum-inspired algorithms look a lot like our algorithms. So I'm feeling pretty good about that. So the first thing I learned is that you can run simulated annealer, genetic algorithm, Markov chain Monte Carlo, and you can run it on Microsoft Azure. That's great. I got a server right there, $2,000 server. I got my Mac right there. I got a laptop. I was thinking of buying another server, by the way, like a 10 grand server, like a beast. It's going to have a fan and an air conditioner, like all to itself. But I can also use Microsoft Azure for free, and then 1QBit has some stuff in there. It's nice. So we're going to do a lot more learning about Microsoft Azure Quantum and maybe develop a service for a specific group. Who knows? I don't know. Next thing I just want to talk about, this is the political arm of the discussion. So I'll be very quick, I promise. One is, I got real concern over pipelines in the United States. So when you cancel an XL pipeline, what are you doing? What you're doing, you're causing a lot of problems. Let me explain why I think that's a problem. XL pipeline map. I actually don't want to be political. I just want to show you something. Can I do this? Can I make this big for you here? I think I can, right? All right, here it is. Here's the Forbes article. I probably should save you the Forbes article. Let's do that. All right. I don't know. It's weird. All right, I can't use that picture. Please come back. All right, we're going to use this picture. So what happens is right now, Canada got a lot of oil, got reserves, Saskatchewan. So right now, the oil comes down. It comes down close to Winnipeg, and it comes straight down. Now, Patuca, right here in Illinois, we got refineries. We got big refineries. We love this stuff because we can process the oil. And then you got Cushing, which is another major stop. And then you got down to Houston, Netherlands. This is where you can start to export. And so what's important is Baker is also a place where there's a lot of reserves. And so by putting a pipeline from Hardisty to Steel City means that you can get oil to the Illinois refineries, to Cushing, and then basically out to the refineries on the coast and even exported if you'd like, or just sold within the United States. You're basically tying together Canada's ability to produce oil with the United States' ability to consume it, to process it, make profit. I love that. Binds us together. It makes North America energy independent. No more wars in the Middle East. No more OPEC. No more stress. We're good, right? Now let me show you the alternative. The alternative is we pipe the oil all the way to St. John, right? This is just crude oil, right? Let's get it out to St. John. Let's export it. Let's let Europe handle it. Maybe Europe can refine it. Or let's send it out through Vancouver or Kitimat. There's a nice idea. You know where that oil goes? It goes right to China. China's got great port facilities right on the water, and they're ready to refine this stuff, and they're ready to use it. So now Canada is feeding China's energy independence needs. In the United States, we're probably going to be importing oil from Russia and Saudi Arabia, which I guess that's fine, right? They're going to be our friends forever. Russia, Saudis, Iraq, whatever. I'll be honest with you. I think you need the pipeline. I think you bring it back. And I think you strengthen your pipelines you've already got in the United States. Now, one of the reasons to be against a pipeline is you could say it's dirty, it spills, right? Well, how does the oil get there now? They put it either on a truck or they put it in a rail car, and it spills. And if a rail car turns over and catches on fire, it's like a bomb, okay? You put it in a pipeline with all the controls and the pressure sensors, and you really can manage very effectively, very environmentally soundly through a pipeline. Pipeline's better. And the other thing I saw was there's concerns over the South China Sea right now. I don't know if you guys know, but we have an interest in looking into the South China Sea. It's a little bit of a hobby, but it's also a quantum thing. And we just had simulated war games in the South China Sea. This is not helpful. It's basically simulating World War III. And so you got some tension in South China Sea right now. I'm not going to show you anything. Also, we did not make any additional progress on the IBM Q. We made no progress on QAOA, our own version. But we are looking at new types of hardware, so that's always a good sign. So that's what's going on with our business. It's good. It's good business right now. We're making reasonably good money in the market. We're trying to change our approach and give you, the user, more information. So if you come to our website, it used to be all I ever wanted to show you was how to buy something. Now what I want to show you is all the FAQs for the stock market. There's a lot of them now. As I go through and learn things, I'm putting them in here. And I'm actually paying for advertising to get people to look. Then if you scroll all the way to the bottom, then maybe you can do a little shopping. You can buy an analysis. But for right now, it's really about teaching you all the things that we're learning about stocks as we go through this process. And if you ever find things that you don't know that you'd like us to add, go ahead and do that. If you'd ever like to connect with us on Twitter, we're Chicago_Quantum. Got 1,440 followers, which is great. We try to put out a lot of information for people. And, well, that's it. Thank you very much for listening. Appreciate it. Have a great rest of your weekend, and talk to you next week. Bye-bye now.